Welcome back. My name is Chris Gosselin from Australian Fund Monitors. Today we're talking to Ben Harrison, co-founder of Altor Capital and CIO of the Altor AltFi Income Fund. The fund is in AFM's private credit peer group and has a track record of 8 years, over which time has returned 11.52% per annum, and it has 107 million in funds under management. Ben, welcome. Can you start by providing a quick overview of the fund's investment strategy, how you differentiate the fund from others in the private credit sector?
So we're what's called an active credit manager. So we're looking at purely corporate credit. So we don't do any property credit, and we're active in the sense that we actually get involved and are actively partnering with the borrowers that we're lending to. So quite different to maybe a traditional credit manager who's very, more traditionally hands-off, I guess, and looking at more traditional reporting, covenant reporting, and semi-regular check-ins. We're actually actively engaged with the business either through board positions or through some advisory role where we're helping the founders or the executive of that business execute on a growth strategy or a corporate strategy.
So it's sort of a combination of private equity type approach as well as private credit.
Yeah, very similar. It's what we call a private equity mindset. So when we're diligencing the borrowers and we're looking at entering into our loan agreements, we're really trying to understand what growth opportunities are there in the business. And then once we deploy the capital, it's about how do we assist our business in achieving its objectives. And that allows us to do two things. Firstly, protect the capital. If we're engaged in the business, helping the business, then we can keep an eye on things. But we're also taking attaching equity instruments as well in the borrowers. So they're free attaching equity instruments. They may be options, warrants, or freely issued shares. And that allows us to enhance the returns of the fund. And as we are actively engaged in helping those businesses, it also allows us to get a greater certainty on generating a positive return from those embedded equity instruments on top of the interest income that's coming through the loans themselves. So you get the combination of quarterly interest and all the income that comes through from a traditional private credit structure, but you're also getting these equity returns as we execute on the business objectives of the borrowers.
And as we can see from the cumulative chart, that gives you a real performance kicker when those options or warrants come into play and you can realise their value.
Yeah, and you can see that it'd be worth having a look at our performance graph when you can, in terms of just seeing the incremental kick-ups across the last 8 years. There's about 5 or 6 of those that we've realised over the life of the fund. So you definitely see that translate into additional performance outside of the running yield on the loan instruments.
Ben, the fund is quite concentrated. As I said in the intro, you've got about 107 million, just over 107 million in funds under management. That's spread across quite a small number of loans, which means you're quite concentrated. How do you manage the risk on that in a concentrated portfolio?
Yeah, so it's really that active nature. So from our perspective, our challenge is being able to be across as many portfolio companies as we can. And because we're a team of individuals, there's a limitation of how many borrowers that we can lend to. That's up to kind of 20 to 25. So, in our world, we're limited by human resources, but the converse side is that because we're actively engaged in those borrowers, it allows us to be concentrated, and that way we can actually concentrate the returns, particularly around those equity instruments. All the borrowers that we have, say for one, have embedded equity. And the reason why that borrower doesn't have embedded equity is because we actually exited that equity position last year, and we're about to exit or get refinanced on that loan itself. So the concentrated nature actually allows us to be actively engaged and drive higher returns from those companies that we have investments in because of that embedded equity position.
What are you seeing within private credit, and how do you view that sort of focus on the negative that has been in the media for the past 12 months or so?
Yeah, I think every sector has its positive momentum and sometimes some negative momentum, and private credit has had a large groundswell of investment over the last 5 or 6 years, particularly in Australia. So we were at the forefront of that when private credit was, starting to, make up a part of investors' portfolios. And I guess what we're seeing that's kind of well publicised, so I won't kind of, keep drawing to those articles, news articles that exist. But what's happening in the US context is very different to what's obviously happening in Australia. In Australia, we're lucky we have a PPSR system, or a security register system that allows us to easily take security that is defendable in Australian court of law. So that's obviously very different to in the US, where it's very state-based. So it's hard to actually protect your security. So that's one thing that's quite different. And the other thing which has happened, I guess, post-COVID is a lot of those US private credit funds have invested and lent quite heavily into technology businesses. So we've seen this disruption in technology on the back of AI. So a lot of those technology businesses are struggling, and in Australia in particular, that actually hasn't happened yet. And in particular, in our fund, we don't have any technology exposure in the portfolio. These are all kind of traditional businesses that we're investing in and lending to. So that's some really, and I'm kind of oversimplifying it, but if you kind of look at it, its core concepts, it's the way that we can securitize and get defensibility and protection around the loans, but also, avoiding those sectors that are very cyclical. We are a macro thematic investor as well. We didn't touch on that, but we're, really interested in and looking to deploy capital into those businesses that are exposed to industries that have got really strong industry thematics. So defense industry, financial services, healthcare, those types of industries, not cyclical technology businesses.
And do you specifically avoid property?
Yes, we don't invest in any property at all. That was one thing we really wanted to differentiate on. We wanted to be very focused. We talk about sticking to our knitting. So we're really just focused on that corporate lending space, not the property lending space.
And are there particular industries or themes that you're looking at the moment? And has there been any change in that, or do you see any change as a result of the problems in the Middle East at the moment?
Not particularly. I don't think anything's changed based on that broader macro thematic. We do like energy. We do have one portfolio company or one borrower that's exposed to gas field services. So, we think that they're very well positioned, particularly given the disruption to the Middle Eastern energy market. They're very focused in Australia, where we produce a lot of LNG. So we think they're very well placed on the back of that. But fundamentally, we're looking at industries that should really be quite defensible against these small geopolitical events. Well, not small, but, what I consider short-term geopolitical events.
Ben, just on the mechanics of the fund fees, that was another aspect that ASIC focused on, was where do the fees go, loan establishment fees and those sorts of things. Do they come to the manager, or are they put into the fund?
Yeah, so they go into the fund. So all fees associated with the loans themselves go to the benefit of the fund. So whether they're establishment fees, early exit fees, default fees, interest income, they're all for the benefit of our investors.
Ben, it's obviously worked pretty well over the last 8 years. We wish you all the best going forward. Look forward to catching up again soon. Thank you for your time.
Thanks for having me.